Hello, everyone, and welcome to our March investment market update. Today, I'm delighted to be joined by Adam de Koning, who is a portfolio manager for the EMEA equity desk in the Dimensional London office. Adam began his career at Dimensional in 2014, so probably considered a bit of a veteran there, and started his time in the Sydney office before moving over to London in 2019. Adam, thanks very much for joining us today. How are you?
Good, thanks, Mike. Thank you for having me.
Good, good. Well, look, as with what we do mostly, I think you've got a presentation to run through. We had a bit of a brief call earlier last week just to discuss the sort of themes that we might be discussing. And obviously, there's been a lot going on in the last few months. So hopefully, it'll be quite interesting to see your thoughts on that and general macro overview of where we are in the world. So over to you.
Thank you. I'll just get the screen up here. Hopefully you can see this. So
Perfect.
yeah, as Mike said, we'll be walking through, I mean, given it's March already, it's going to be a little bit less of a market review like we might normally do, and more of a bit of a forward-looking view of how we at Dimensional are sort of looking at the world at the moment. So we're starting to get a lot of questions from our clients around things like, I mean, what can we expect for 2025? We've got a new president coming in the US. What can we expect from President Trump's second term? What can we think about all these tariffs? How's that going to affect our portfolio? And just questions like that. So it's going to be a bit of a forward-looking view, and hopefully it just gives you some talking points to start addressing some of those questions. So just to begin with, we'll start with a very quick overview of markets. It's just really going to set the scene before we jump off, and then we'll start looking at some of the theories. So, some of the themes. Sorry. So it'll be on the forecasts and then onto the tariffs and whatnot. So beginning with the overview of the markets to sort of set the scene, 2024 was, in absolute terms, a very good year for global equity markets. We saw this is all of the markets here. So global equities returning over 18%. So a very strong year in absolute terms. And if we start to drill into the regions here, we've got the UK performing quite strongly at 9%, emerging markets performing similarly, 9%, and then developed ex-UK very, very strong at over 20%. And I'm sure it's no surprise this is largely being driven by the US. So in terms of global equity markets, the US portion in this box is about 2/3, and in this box it's closer to 3/4. So very, very strong or very large component in terms of the weight here in the US. So there's some very impressive numbers for 2024. I mean, if we just throw our minds back to what sort of went on in 2024, there was a lot of sort of news coming out and being digested in the markets. There was a lot of political elections throughout the year. I think there were about 80 elections around the world, most of which had either incumbents losing office or being forced into coalitions, things like that. You've had the AI boom. You've had further conflicts in Europe and the Middle East. You've had more news on the future of AI and where that's going. Is it sort of boom or bust? So there's a lot of news coming out into markets, being digested in markets throughout 2024 on the way to these numbers. So to sort of put it into the question of where do we see 2025 going here at Dimensional, we thought it'd be useful to wind the clock back 12 months and sort of take a look at what the market was saying in late 2023. So we're going to take a look at some of the market forecast just to sort of put a dimensional view through this. So if we wind the clock back late 2023, we've got some of the predictions here from some of the major players in the market. So JP Morgan, the view was expecting a downside for equities from the current level. Fidelity, much the same, with a little bit more color around unless we see something extraordinary, and Goldman Sachs largely seeing the same. So this was a bit of a common theme among equity analysts about what to expect from the market in 2024. Now, in terms of what was happening, by the end of the first quarter, markets were up by 10%. in the S&P 500. By mid-year, it was up 15%. And into the second half of the year, we started to see these walkbacks coming in some of the predictions. So it's just sort of putting a bit of color around. It's very difficult to predict what's going to happen in markets. I mean, it's no real surprise, but these sort of forecasts, they're often subject to quite frequent revisions.
Well, I think the thing there, Adam, is it's such a stark contrast from we expect downside for equities to all of a sudden 6 months later, it's going to continue to do really, really well. That's a pretty dramatic swing. Is there anything in particular that made that such a swing that you can say is standout?
Not really. I mean, it's difficult to say. We've got a little bit of a slide later on. It's sort of that disconnect between the short term and the long term views. So yeah, it's just difficult to say. I mean, you look at the news coming out and markets are just reacting to it differently than some analysts are seeing, and it just sort of highlights how difficult it is to try time these things. I
Yeah.
mean, it's
Yeah, and actually does re-emphasize the point, doesn't it? You know, you can't time the market, but time in the market ultimately you will see the growth over time. It's just so difficult to assess. And if these three large houses are struggling to determine what's going to come down the tracks in the next 6 months, it kind of stands to reason that we as individuals will find it infinitely difficult to do so ourselves.
yeah, absolutely. And I mean, it's going to be a little bit of a theme through this talk about, as you very correctly say, Mike, it's a bit of a truism, but it really rings true as time in the market's far superior to trying to time the market. And I mean, these are a bit, well, they're qualitative. We've got the quantitative numbers here in terms of where analysts were forecasting the S&P 500 returns over 2024. And I know like it's very difficult to predict the future, of course, and you don't want to pick on too many people too much, but if you reshuffled your asset allocation because you were listening to Morgan Stanley, you would have missed out on a very significant upside in equity markets. So it's just, yeah, our house view here is that if you're a long-term investor, like you and perhaps your clients, and you're putting together an investment plan for retirement, you've really got to keep your eyes on the prize and not let yourself be swung too much by short-termist views about where we see the markets going over the next 6 to 12 months, and really focus on your own investment horizon of maybe decades into the future.
Sure.
So what we've got here is actually putting it to the larger subset, just to show we're not cherry picking too much in terms of what analysts were saying, but this is sort of the broad market survey for 2024. So we've ruined the punchline a little bit showing what's coming, but you had the median here at UBS at 1.7%, and this is the range in terms of the historical average. The S&P 500, it's about 12.5%. And of course, what actually happened came in at over 23%. So even if you were predicting, average returns this year, it's going to be a pretty good year, it's still coming in almost double that. And to sort of hammer the point home, 2024 isn't really an outstanding year or an outlying year in terms of this. We've got here, again, this is going back over the last 5 years or so. We've got our same 12.3 average here. If we add in the ranges again, high and low, and the median in the middle, we've got a decent range around it. But then if we plot what actually happened in the S&P 500 throughout this time, again, we're often seeing it falling well outside on the upside and even the downside in that 2022 year. So again, it's really just saying our view here is some people can time the markets, fantastic. But if we're talking about how we at Dimensional here are looking forward in 2025, what can you expect from your portfolios here? It's very much going to be centered on that long-term view of markets, trying to harness the power of markets to try create well-performing portfolios rather than really being reactive in terms of entering to trades to try time this market. It's really not what we're trying to do here at the firm. Now, it's not necessarily restricted to equities either. Again, just for the sake of completeness, we've added in some other asset classes here. So equities outside the US, developed in emerging markets, as well as different asset classes. So this is a forecast from 10 different asset management and investment advisor firms who had a 10-year investment forecast leading into the end of 2023. So again, although some forecasts showed to be more accurate than others, oftentimes it's just not reliable in order to build an actual live portfolio around it. So leading on to some of the other questions we had, that's sort of our view ahead for 2025. It's very much stay in your seat, stick to your asset allocation. Oftentimes we find these market outlooks, they're often raising more questions than answers. Again, it's sort of short-term views. Oftentimes they're anchored on more emotive issues and really pointing at whether investors can outguess the market or not. So some of the other questions we're getting specifically are defining Trump 2.0 and tariffs. So just in terms of how we can start thinking about those through, I guess, the dimensional lens, we've just got a couple of points here. So I guess one of the big ones is now that President Trump's assumed office, he's being quite vocal about unwinding ESG focused measures, how the US is sitting on black gold, his slogan of drill, baby, drill. These sort of I guess, policy indications about where he might be encouraging business. So what we've got is looking at the winners and the losers in elections. So is there any information in which sectors we can expect to perform well once a president comes into office? So the way we've sort of broken this up is looking at the best and worst equity sectors going into the election month. And it's no surprise, again, this is all relative to market. So the winners are outperforming the broad market by a bit over 6%. And those sectors which are viewed to be sort of not in favor with the new coming president and their policies tend to underperform by a similar amount relative to the market. The question then is what happens for the rest of the presidential term? And we see it to be flat. So what we take from this is the market is very good at efficiently pricing in the impact from the incoming president on the prices, on the expected future performance of these companies and sectors, at least over the next 4 years. So when
What does that really, sorry, Adam, just to cut across you, what does that really indicate? Does it mean that businesses, I know the markets price it in, but also is it just suggesting that whatever the political wind, businesses will to some degree carry on regardless and not, there might be the initial sway based on potential feelings as to the direction of travel, but actually after a while it's baked in, businesses carry on just doing what businesses do? Or is that too simplified?
I mean, businesses do carry on doing what businesses do, but there's definitely impacts to policies. I mean, President Trump's broad and very vocal support of the energy sector saw them doing quite well. So you do see a reaction, but it's more saying once this has happened, it's largely priced in. Doing any sort of tactical reallocations now, or even a few weeks after it's announced that he's coming in, is potentially too late because you've gone from where you've got a spread to it's largely flat or there's just no real signal. So it's kind of coming back to just the power of the market. Some businesses will do better than others, but it happens very, very quickly within the sort of even the days after you see the price adjust with these new expectations. And after that, largely quite flat.
And I guess it really comes down to, like we keep saying, it's about making sure you have just a very broad, diversified portfolio, because it's always very difficult to determine which area will do better over another. I mean, you can have obviously some views and some ideas, but as we've seen from the slides before, a lot of the larger companies just even 6 months out cannot actually understand what's necessarily or predict what's going to happen in a particular market, let alone sector specific. So I guess having that diversification, that broad allocation, gives you the best chance of capturing the upside.
Yes, absolutely. We'll come back to a bit later in the presentation as well, the importance of diversification. But yeah, it's critically important, we think, at least, when you're building a portfolio, because as you say, Mike, it's incredibly difficult to pick ahead of time. And even, I mean, we look at these, it might look obvious in hindsight, but the election wasn't a foregone conclusion. It could very much have easily been swung exactly the other way, and we'd be talking about it very differently in terms of portfolio returns. So another point we can take a look at is tariffs. So one of our big talking points here is that tariffs are really only one of the factors that can impact security prices. So again, as we've talked about, you've just mentioned it there perfectly, is that broad diversification is one of your best defenses. Tariffs, although economically speaking, they're going to generally harm a broader economy, they will impact some sectors more than others, and you may even find that they help small segments of the economy. And it's also, we've got a bit of a roadmap for what happened last time. President Trump was very vocal in using tariffs as a policy instrument in his first term in office. So starting in 2017, there were those trade talks announced, which were going to go for 100 or so days. They didn't materialize in any meaningful changes or any meaningful outcome. Throughout 2018, there were back and forth sort of tit for tat tariffs covering a wide range of products, probably steel and aluminium being some of the largest, almost publicized ones, and then on through 2019 and 2020. It got to the end of 2020, Trump exits office, the tariffs are largely still in place and they remained in place. What we can do is we can look at how the US and China fared during this period. We see China in the green, the US in the blue, all this tariff talk, both of these countries outperforming the developed ex-US market. So again, tariffs are just one input to how a single company is going to go, never mind rolling it up in the aggregate to whole countries and how they'll perform. And even then extending it from a country's GDP, where it talks about these tariffs worth X% GDP, making that link again to an equity market. It's not one for one. There's a lot of different inputs going into these. It's not a simple case of saying tariffs are going to crush the stock market return. Again, it's making sure we're invested for the long haul because it's just one input here. Now, to put it in slightly different terms, we can look at a set of markets. So we've got a control group here. We've got the EU. The countries in the EU trade as a bloc. They impose trade restrictions as a bloc. They've got the tariffs as a bloc. Each of these imposes a 2.5% tariff. Again, this is on average across goods. Sometimes it's higher, sometimes it's lower for different goods. But what we've got here in this column is the different countries in the EU. They're marked out here, and their equity market returns in 2023. There's quite a large spread, as you might expect, between Greece up the top here, and you've got Finland down the bottom, and a spread between the best performing and the lowest of 50 percentage points. So again, tariffs here, they've all got the same tariff on their goods, massive spread in equity returns. Rolling forward a year, similar sort of concept. The tariffs are just one input into what's going on here. It's not to downplay the significance of them in certain segments of the economy, but again, a broadly diversified portfolio investing across all of Europe, you're going to make sure that you're smoothing out the impact of that tariffs as it comes through. There's no real pattern here to which country is performing better. You see Finland jump up from the bottom to, I guess, top third. And then if we look it out across all the years, again, there's no real pattern here. Tariffs, again, are just one of the inputs. The key defense here is having a broadly diversified portfolio, focusing on the long term to really smooth out that impact that you might expect from a single company or small sub-segment, say European alcohol producers being impacted by the US wanting to place tariffs on champagne or something like that. Having a broadly diversified portfolio will be a key defense against that. Another point, moving on to what the market's expecting from inflation. Will tariffs push inflation up? This one's more looking at just point in time, I guess, expectations of inflation. So if we look at how the market's pricing inflation over 1 and 4 years, we see the 1 year here and the 4 year, both of them below the actual median long-term inflation rate. But above, this is in the US, above the target rate of 2%. So investors are pricing in some inflation into goods, but it's below the long-term average here. In terms of what we think investors can do with this information, many asset classes, equities among them, outpace inflation. So if you're wondering what to do in the face of higher expected inflation, oftentimes equities are just a great starting point. Equities over the long haul have outpaced inflation, and if it's unexpected inflation that your investors are worried about, there are again securities which can assist with hedging out that sort of risk through inflation-protected securities.
So Adam, just quickly on this, looking obviously at that longer term trend, we all knew that inflation was going to tick up a little bit, which we can see here. First trading day after the election, actually relatively flat in terms of expectations for inflation. And I presume this has been revised since tariffs have come in, or okay, so that's kind of saying that actually they don't think tariffs are going to have a dramatic impact on inflation. It means it might stay above the 2% target, but actually flatline is surely better than increased inflation due to tariffs. Is there any particular reason behind that? Is it just because it's a tit for tat scenario between countries on tariffs that effectively equalize it out, or is there more to it?
It can be a little bit of an academic argument for what happens. So the tariffs won't necessarily increase the rate at which prices are increasing, which is what the inflation is looking to capture. It might lead to a jump up in the price level, but it's not going to change that sort of steady increase rate. And you're right that it is sort of just flattening off a bit. There's not a massive run up in the expected inflation because of the tariffs.
Right, thank you.
One of the other pieces we've been looking at over the last few years now is the widening spread between the price of growth stocks and value stocks. So again, this is in the US. It's large cap growth comparing to large cap value and the long run price to book. So essentially measuring how expensive or the valuation ratios of growth stocks compared to value stocks. So we see value stocks being relatively flat in their valuations, and the growth stocks growing larger and larger. Now, a point here is that we mentioned it earlier, the growing concentration. So diversification, the flip side of this is how well the S&P 500 performed over the 2024 period. Part of that was due to the outperformance and the really great returns of the Magnificent Seven. That group of those 7 mega cap stocks performed very well. We recall that the S&P 500 returned about 23% over that period. If you strip the Magnificent Seven out, that return falls down closer to 16%. So that group of stocks, in terms of a weighted average, if you just had that portfolio, it would have been about 48% return in just that group of stocks. It leads naturally on to higher concentrations. So the Magnificent Seven, toward the end of the year, their weight, or the weight of the top 10 in the S&P 500, was approaching 40%. So it's beginning to become a bit more of a concentrated, more and more concentrated portfolio. If you use the Russell 3000 as a bit of a more broad measure of the US equity market, it's about closer to 32%. So it's a bit lower, but it is still high. And it's just sort of getting to that point where even a broad base index there is getting more and more concentrated within a handful of larger and larger stocks. and you're potentially starting to lose some of that diversification, which you might want in a portfolio. If we compare that to the world allocation funds and the world equity funds, which you're invested in and using, that's a global solution. The weight in the top 10 there is close to about 11%. So it's a very, very broadly diversified portfolio, making sure it's smoothing out any of the sort of large swings you can get there.
I think that's always an interesting point to make, isn't it? That the difference between the way you're operating and lots of portfolio managers operate is to de-risk to some degree the exposure to a select number of companies. And there's always the individuals that might say, well, okay, had I been exposed more, then my returns would have been far greater. But that's always great in hindsight to look back and say, had you been exposed? But there are also the situations you can see from that graph there that some of those large growth stocks took quite a tumble in one period of time. So it's about timing and as much as anything else. So, for me, it's always been about diversification and making sure that you have exposure, but you're not overexposed, because that can effectively skew your risk profile exponentially away from what it actually should be. So even though you might be a high risk investor, for example, if you are in a very select number of companies, well, your risk is exponentially higher than it would be if you're diversified across. So I just wanted to make that point because I think it's important when everyone looks at it and thinks, well, had I been invested, there's that sort of always that buyer's regret, so to speak, in hindsight. And it's just trying to dispel that, really.
Yeah, absolutely. I mean, you're not rewarded for having very concentrated positions, essentially. I mean, it just goes back to what we learned in university days, that idiosyncratic risk, which you can diversify away. You really should diversify it away because it's essentially, as you say, uncompensated risk, which can just skew it a lot. Just to close out, I'll just leave with these market predictions again. So if we're looking at the market predictions, oftentimes they're short term. It can very much go in the face of what an investor's objectives might be over the long term. So just trying to marry up, you've got these predictions coming out from analysts in the market. They're looking over the next 6 months to a year. They're being revised every few months, comparing that to investor objectives, which are longer term and really changing when there's significant life goals or life changes occurring. And the final slide, again, you sort of mentioned what's leading to these changes. This is just a slide marking out some of the things that happened and came into prices during the year. And again, it's just difficult to call. I mean, you've got US inflation concerns early on in the year. You've got a rally sparked by Nvidia. You've got concerns about the government shutting down, a little dip, and then stock prices just going on again. So again, it just comes back to time in the market. We can't predict it. We're just going to make sure that our portfolios here at Dimensional, which you're investing in, they're just going to be focused on delivering the equity premium along with the other premiums as well, small cap, value, and high prof, just to keep that consistent exposure on them. It's not going to be a reactionary trying to time the market because some news headline just came out.
Fantastic. I think this is a brilliant graph just to show the amount of things that go on in any one year. And as you say, some of these things here don't necessarily have an impact. Others have a disproportionate impact. I've always kind of said that the markets can be fickle to some degree and that knee-jerk reaction to news can sometimes happen. But ultimately, I think what's proven here is regardless of what's gone on, and there's been quite a significant number of issues that you show on this graph, the upward trajectory on this occasion has been relatively positive. And yeah, it's just about trying to cut the noise out, I guess, longer term, or shorter term rather, cut the noise out shorter term for longer term growth.
Yes, absolutely. It's just about controlling what you can control. You can't control what's going to happen in the equity market, but you can make sure you're doing your best to position your portfolio so that you're not exposing yourself too much and controlling those risks that you can.
Absolutely. Well, brilliant. Adam, I really appreciate you coming on. Thank you ever so much for your time today. Everyone, we will be back in the next month or two with another investment market update. Thanks very much.
Thank you.